Morning, folks. Good morning, good morning. How are you guys doing today? Everybody hear me okay? Even if you don't wanna? Good morning, Steve. Nice to see you. Alright, guys. Erla, Nanda, good to see you. It's nice to have you guys here today. Welcome to the room. Hope everybody had a great weekend. Hope your team won if you have a team that played. What's up, Rob? My team won. So life is pretty good. Guys, we're going to go into this week pretty focused. We're going to talk about a lot of things that tend to repeat themselves. We're going to focus on a little pattern recognition and a little bit of patience. It's going to be a fun week. You'll find that it is pretty much what we did last week and the week before. And almost what we've done every week for the last 28 years that Nexgen has been around. Let's learn a pattern that wins more than it loses, that you can prove wins more than it loses. Let's accept that pattern as our rules and then strive to only trade that pattern. That's exactly what we're going to work on today, guys, because advantages are what we're looking for. The first advantage that I give myself every morning is I come to forexfactory.com /calendar, and I make sure that there's not any high impact, no medium impact news floating around. Today is Monday, January 13th, and at 2 o'clock there's the federal budget balance, but that's low impact. We're not expecting a big bounce or anything. I'm always looking for these red boxes and even these orange boxes. And for me, this is just a little heads up. It goes, hey, Mark, somebody might react like with a lot of emotion to whatever is being said in this news release. You may not want to be in front of their response. You might want to go make a sandwich or pet the dog or call your wife and tell her you love her. Anything other than stepping in front of that reaction. So I do that every morning. It's a big part of every day. It's literally coffee news, guys. And then everything that I talk about each and every day, you will find it here on the Nexgen site. Even more specifically, the trading guide is what on earth is happening with this. This happened last week too. Let me take a picture of this. And I don't know what destination. I must have something going on in my life here that isn't right. There we go. This is the education page, guys, and this is where all the answers come from. And this is like the big version, the wordy version, the AI generated version. This is where everything, when we talk about rules, what they look like, there's so much information on this page that it's easy to get lost in it as a brand new user. So what we're going to do here in the classroom is we're going to take all this great information, but guys, I'm going to whittle it down to something that I understand, and hopefully something that becomes very clear for you. We're going to talk about a high probability trade this morning, and this is what we talk about every morning. And I know you're like, man, Mark, we already talked about this. Show me all the trades. Guys, this is the trade that teaches you to see the rest of the trades. The high probability trade is the trade that typically wins 70 to 80% of the time when you learn how to follow the rules. This is the trade that creates confidence through that memory of success. And the most important thing that this trade does is it teaches you to read your charts, to look at, let me start this up, there we go, to look at your charts and just say, okay, my advantages are in place, I'm going to look for an entry, or to be able to look at your chart, more importantly, I think, and say, I just don't have what I need to feel comfortable risking my money in this trade, guys. Chart reading is about 90% of your day. And I know that we've got some new folks in here. Elle, it's good to see you back in here. Oh, Miss Andrea, you showed back up. Nice to see you too. Hope you guys are doing great. I like it when I see the people come back in. Guys, 90% of your day is really sitting on your hands. 90% of your day, it's a whole lot of nothing. Because your rules have been proven to win more than they lose, and there will be times when your rules aren't met, when they're not true. And the best, hey Gary, good to see you. One of the best things you can do when your rules aren't met is simply nothing, because your rules are the advantages that it takes to have that statistical advantage each and every time you pull the trigger. Your chart reading, when you start to feel comfortable with it, when you get good at it, you're going to understand three really key concepts, guys. You're going to understand where the market is likely to continue. Initially, likely to continue is where the trend is most likely to continue in the direction it's been going. And this is your entry for the highest probability trend trade. You'll understand where the market is likely to go. This is going to help you with profit taking at the right spots. And you're going to understand where the market is likely to stop. And likely to stop is what we call a termination condition. And a termination condition pretty much has the potential to halt the forward progress of the market. And you see these long before you get to them. It's a very simple recipe to identify them. And guys, rule number 2 is going to keep you out of, and this is these termination conditions. It'll keep you out of consolidation and chop, and it'll keep you from having to hope that the market does something rather than just allowing the market to do what it does. So it's 3 rules. Hey, good morning, Cav. Good to see you. 3 rules is the high probability trend trade. That's it. And we're going to keep these as simple as possible, guys. Each rule, when it's met, when it's true, gives me an advantage. So the rules are in white and the advantages are in yellow. Strong triggers, rule number 1 on your large chart. This gives me the advantage of momentum. When you look at your chart, hey Dima, nice to see you. When you look at your chart and you say to yourself out loud, and you'll say to yourself out loud because it's important to really talk through this. You'll say, I have the advantage of momentum with those strong triggers. This is a market that is likely to continue in the direction of the trend. This is a market that's likely to push. This is a market that has the potential to break areas. This is the market that's given me the advantage I need that can even cover some of the mistakes that I might make as a new user. Guys, momentum is rule number 1 for a reason, and it's a very simple lesson. Hey, Bob the man, good to see you. And then rule number 2 says termination conditions false. Guys, that means that you're not trading into any of those areas that are likely to stop the market. None of those termination conditions. And this is going to get you room to your profit targets, which is important. Hey, good morning, Miss Cindy. Happy Monday to you. Room to your profit targets means there's just nothing in the way, nothing to create a bump or a bounce or a jump. And this is what we're going to call the advantage of a clear path. So both of these rules are not difficult to identify. We're going to break them down individually, what they mean to you. But these 2 rules are the core. These are the core of everything. This is the foundation. Once you understand momentum and path, and guys, commit to having a mastery of these 2 concepts. Because once you do, you have everything that you need to be successful with this software. You have everything that you need to create a very consistent trading plan. And you're going to see people in this room that really trade with nothing more than momentum and path. They don't even incorporate that high probability trend trade entry rule. But we will, because I love trend trades. My whole trading plan is trend trades, and they work. And guys, the entry area comes from rule number 3. And this is the one that's going to put you into the market where the market is most likely to continue. And that's really what we're going to do. We're going to take these 3 rules over the next hour. We're going to break them down, and we're going to look for them on only 2 charts. There is a large chart and a small chart. Excuse me. And I'm not going to lie to you guys. There's a million charts that you could build. A million bajillion combinations. But we really only need 2 to catch this trade to identify these advantages. And what's amazing, because we really are keeping it simple, it's the first bar, the most current bar, the bar that's active on what we call the large chart. This is your 13.2 on the crude oil or the S&P. This 1 bar on your large chart will define the direction, the momentum, and the areas of the market. Guys, this is a very broad stroke of a brush. Your large chart is a slow-moving chart. It's difficult to see change on this chart. And it really gives the overall opinion of the market. When this first bar tells you the market's going up, it's going up with strength and there's nothing in the way, guys, rules 1 and 2 are already met on the large chart. You have 66% of the great things that you're looking for already in place. Once they're there, we're going to go to the small chart, the entry chart. And I think it's important to call it the entry chart because the entry only comes when the rules are met and tell you to look for it. And guys, inside of this one bar on the large chart is about 20 to 30 bars on a smaller, faster chart. You literally see the inner workings. You're going to see what looks like a big pullback, a change of direction, and you're going to see it continuing in the direction of the trend, all inside of this one bar. The refinement chart, with that 20 to 30 bars that it breaks it down, it's like an X-ray. That is going to pinpoint your area for entry where the market is most likely to continue. You're going to use this chart and it's going to allow you to reduce risk and it's going to allow you to maximize profit potential. And rule number 3, guys, all it is it's a refinement and it's pinpointing your entries. And great entries create very manageable trades. So we use these 2 charts because you should know who you're trading with or who you're trading against. I always love this analogy. And Novak men, just for the record, are horrible at analogies, but my brother nailed it on this one. The big chart is the large crowd. These are the men and women with the money and the influence to create trends, to establish momentum. These are the same people that react at those large chart areas that could be problematic for you guys. And going with the flow, following the large crowd, doing what they're doing and not trying to fight them is the path of least resistance as you work towards your success. The small chart is the small crowd. These are the folks, they have a lot of money. They're still pretty influential. They're a lot of fun at a party, but these are the guys that pick fights. And when the large chart says up, these guys want it to go down. And when the large chart has momentum, they want to go against it. And the cool thing is the large chart is such a big group that the small crowd typically fails 70 to 80% of the time. Rule number 3 on your entry chart is designed to pinpoint precisely where their failure is imminent, where that market is most likely to bounce, and just go with the large crowd. And the great thing is that if they lose 70 to 80% of the time, if they can't change that trend 70 to 80% of the time, it means that when you follow your rules, when you go with that large chart, when you pinpoint your entries, you have the likelihood of 70 to 80% of success. And that's why we break this down for brand new users. It's important that you learn the trigger line and Fibonacci rules for when it's okay to trade. This is a brand new toy, guys. You have the world's greatest hammer, and now we're going to learn to build with it. So the first hour will be dedicated to breaking these rules down individually, to showing you what they look like on that chart, what they mean to you as a trader. And that's really an entire 40, 45 minutes worth of, it's a little lecture-y in the beginning, I get that. You guys have the ability to simulate, and I think this is one of the great things about the demo. One of the great things as a brand new user is you don't have to drop 20 grand into the market and start trading your live money as you learn this, guys. You have the ability to simulate, to practice. This is your driving range. This is your batting cages. And every time you practice a trade, every time you look at your charts and you're practicing your chart reads, you have the opportunity to take a picture and to drop that picture into the room, guys. And this is how you and I have a conversation. So if you take a trade, win, lose, or draw, I want to see them all because there's great lessons in all of them. You're going to drop it in the room and you're going to say, hey, Mark, this is what I did. And this is what I saw. And this is where I got in and this is where I got out. Am I reading my indicators correctly? Does my entry make sense? Does my exit make sense? Every time you post in my room, ladies and gentlemen, you get a private session with me. We look at your charts, we break them down, and if there's a way to do it better, I'm going to share it with you. And if there's a way to avoid mistakes, I'm going to share it with you. And if there's a way to reduce risk, to hold for bigger moves, I'm going to share it with you. We're going to work on plans together. I will simplify, guys. I struggle to get outside of simplicity. We're going to talk about this high probability trend trade. It will open the door for a second trade that will be given to you in a plan. The goal and the hope is that you learn the looks. You've got to know what they look like. And what's great is the more you study these simple patterns, the slower the market seems to move. you almost begin to anticipate your entries. We're going to talk about breaking the entry down piece by piece, but you'll get to the point to where at a glance you'll know precisely where you want your entry to come from. So there's a process to getting to where you want to be ASAP, and it starts with posting in the room, guys. The people who post the most get to where they want to be the fastest. The people that share pictures with me get to where they want to be the fastest, because one of my gifts is that, one of my gifts, I think anyway, is that I recognize patterns. I recognize patterns in the market. That's a big part of what I do. But I also recognize patterns in you guys. So when you post into my classroom, sorry, I inadvertently deleted every item that I had in my teaching folder this morning. So I'm on a rebuild and I don't own a spreadsheet anymore. So I'm scrolling up and finding it. Guys, the spreadsheet, here we go. Boom. Let me get this real quick. That's the one I dropped in Friday. Whew! Dodged a bullet. Guys, this spreadsheet is the second piece of the puzzle, and there's 4 tabs on it. The first tab is going to be, it's just a trade journal. That's all it is. This is where you, and let me drop it in the room for you. This is where you are going to put the picture of the trade that you took. This is where you are going to identify what kind of trade it was, because each trade that you take is going to have different rules for entry and different management, and I want you to be able to tell the difference between what you're doing. You'll talk about the advantages in here, because you're going to begin to see how well you're doing following your plan. You can talk about wins and losses. I don't think this one is very very important. Honestly, in the beginning, we're focusing on process. And then there's a feedback from class. And Marty, there's your answer from Gary. Thanks, Gary. There's a feedback from class section, guys. And this is where you're going to take whatever we talk about. Hey, L, you traded into termination conditions. That may be why things didn't work out. Hey, Rob, you didn't have that momentum we want. That's why it probably didn't push. Hey, Wayne, you fought the trend, and maybe that's where the success is being stripped from you. Or maybe it's, hey, Nish, you traded with momentum, and you had that clear path, and oh my gosh, what an easy winner. You will get feedback. And guys, the goal is that you come back every morning, and you study the trades that you took yesterday. And you're going to say to yourself, what worked and what didn't work, and what brought me success and what was hurting me. And then through every picture posted in this room, guys, we're going to work together to help you become a more confident chart reader, a more confident trader. And you'll begin to recognize patterns in yourself. And guys, you're going to start to see those patterns in the feedback from class, because I'm certainly going to recognize them in you. The second tab, did anyone do this weekend? Did anyone go through this and start filling this out a little bit more this weekend? The second tab is what it looks like to have the rules met. Strong triggers, clear path, entry areas. It also shows you what it looks like to not have your rules met, when it's time to pump the brakes and not take trades. I'm real tempted to just keep this page from you guys and force you to fill it out yourself, because this is one of the greatest ways to become a chart reader, to break these down individually so that you can piece them together and create a trade. There's the client trade section. Entry sequences, long and short, for the high probability trend trade. From having large chart rules met all the way down to the entry. There's about close to 400 pictures of you guys doing great things with the software. And I've put them in here as a study guide so you can begin to recognize these patterns. There's very, very basic management there that's going to be in the plan that I give you. And then there's some ideas on when you can start holding for bigger moves, or patterns that may take you out a little sooner. And then speaking of patterns, this final tab, guys, these are the patterns that are going to jump off the page once you're reading your indicators. You're going to start to see things, and you'll be like, man, I've seen this 100 times. And 80 times, it pushes that market, and this is how you're going to grow your plan, guys. And that's what the final tab is. This is the Build Your Plan tab. This is the one that says, hey, you know what? This is my look, and this is how I'm going to manage it. And these are some of the pictures I want to take because I'm always growing, so it makes sense that my plan may always grow as well. Guys, the more pictures you take, the more you post in the room, the more you go back and study these pictures, the faster you're going to find the goals that you're looking for. I want you to see my library. I'm at 251 pictures in 2025 so far. We're on the 13th day. I did over 8,000, or no, I did 7,800 in 2024. Guys, I take a lot of pictures, and when I look at my charts, I'm going to be honest with you, it takes me about 2 seconds to know whether or not my rules are met. You will get to that point, but it's going to take a little bit of study, guys. So let's go through the rules, let's break them down, let's talk about what they mean to us, and let's really have some fun. Rule number 1, large chart. Large chart leads the way. It has to have strong trigger lines. Remember, the large chart is going to define direction. The large chart is going to define momentum. The large chart is going to define areas. So we're going to let the large chart lead the way with strong triggers. Your trigger lines are two sets of lines, guys. It takes 2 lines to make a trigger line. So these 2 solid lines are your small triggers. These 2 dashed lines are your large triggers. You don't have to know what they are or why they are or what makes them do what they do, but this is what you need to know, is when the background is green on my large chart, the market's going up. My highest chance of success will come from going up with it, trading with the trend. In order to have strong triggers on a large chart, my small triggers must be green, the same as the background. They must be up and above the large triggers, which are also green, same as the background. The colors are going to match if you have strength. But the pattern, the look, is when the small triggers separate from the large triggers. When space is created between the two, this strong trigger look lets me know that the odds are favorable for the market to continue up. Odds favorable momentum is our battle cry in this room. Odds favorable momentum pushes a market in the direction of the trend. Odds favorable momentum can break key areas. Odds favorable momentum can even cover mistakes. In a downtrend, when my background is red, my small triggers must be red as well. My large triggers must be red. And guys, it's the space that's created between the two. Picture scissors that are open. That space lets me know that the odds are favorable for the market to continue down. And again, odds favorable momentum, guys, this leads the charge. But eventually momentum goes away and you'll be able to see it. You'll be able to literally watch the market slow down as those small triggers return inside of the large triggers. And guys, when this happens, this is a weakening of the large triggers. And when I have weak triggers, anything can happen up or down. Your trigger line lesson is, hey, good morning, Jay, is one picture deep, guys. Strong triggers has separation. Weak triggers means the smalls are inside. One means that your rules are met. The other means that they're not, guys. And if I go to a large chart, what market is this? This is crude oil. Separation between the small and large will always be momentum. Separation between the small and large will always be momentum. And there's the smalls inside of the large, that weakness, and sure enough, look at the giant retracement that comes off of it. So, can you guys give me a why if you're with me, especially my newer users? Rule number 1 is just letting us know that the trend is likely to continue. Rule number 1 is giving us that push that we need to trade with the trend, guys. And the great thing is, it's one bar. If I look at the most current bar, and let's go to the most current bar. My small triggers are red, but my large triggers are green. Guys, if I remember that one simple lesson, that these have to match to have the momentum I need, well then I know that rule number 1 isn't met. And my best case scenario is to simply sit on my hands. If I go to the S&P, I have the same thing. My smalls are green, but my large are red. I don't have the momentum that I need to look for that high probability trend trade. And then finally, here's the NASDAQ. My smalls are below the large. Look at that. Both are wide, both are red, and the space between. Ladies and gentlemen, one of these markets has odds favorable momentum. One of these markets has the potential to push down to continue with the trend. If it weren't for that big, ugly blue line, which is our segue, our transition to rule number 2, guys. Rule number 2 is the most broken rule among new users because rule number 2 forces patience. Rule number 2 forces you to do nothing when there's nothing to do because rule number 2 is going to keep you from trading into areas that may stop the market. And that's exactly what a termination condition is. It's just a Fibonacci area. And it may stop, reverse the market. And guys, these areas are where the large crowd are making decisions. These are where the buyers are buying and the sellers are selling, where profits are taken, where trades are entered. And guys, there's a lot that happens at these lines, and you don't ever have to be a part of that decision-making process. Your termination conditions are essentially horizontal lines on a large chart. And these are the labels. These are what they're called. And again, you don't have to know, whoa, what did I do? You don't have to know what makes them. You don't have to know the math that goes into them. You don't even have to be a programmer to understand them. We're looking for divergence high lines, which is a magenta line that prints off of a pivot if there is a loss of momentum at that pivot. And I want you to associate divergence with momentum loss. If it happens at a low pivot, it's a cyan line, a light blue line. We're going to use red Fibonacci resistance. This is going to be a red line. When the market is trending up, it's the point where the market may stop, bounce, or reverse completely. You'll never know what it's going to be, but you'll have a recipe to know when you shouldn't trade into it. Fibonacci support, the market is trending down. This is where the market may stop, bounce, or reverse completely. I'm going to give you the recipe. There's also these yellow 1-to-1s. When the market's trending up, they behave as resistance, and when the market's trending down, they can behave as support. Guys, these lines can all stop the market cold. There is also a mid-band. I've got this in here because I just want you to know what this is. This is a moving average that runs down the center of your chart. And if price is above it, it's green, it may behave as support. And if price is below it, it's magenta, it may behave as resistance. But guys, all you need to know is that these areas are where decisions are made. So to identify one of these areas as a termination condition, we're going to let the buyers or sellers get to the area. We're going to let price reach the area. If price reaches resistance, your dynamic Renko bars come up and come in contact with resistance, the only thing that you have to do is ask yourself, where are my triggers? If my triggers remain below resistance, this is a termination condition. Rule number 2 is not met. Absolutely no trades into the area. And I'm going to let you in on a little secret. Every time you reach a line, it's a termination condition. No trades into the area. The price bars come down. They reach Fibonacci support. When price reaches support, all you have to do is ask yourself, where are my triggers? If the triggers remain above support, it's a termination condition, guys. No trades into that area. Does that seem too simple? I've had people tell me, Mark, there's not enough to that. It can't be that easy. Let me show you something. This is the NASDAQ, which is a crazy violent market. And price reached Fibonacci support, and it bounced up to resistance in the midband, and back to support, and right to the midband, and back to support, and straight to resistance. And ladies and gentlemen, this is rule number 2, keeping you from getting caught in consolidation. From resistance to support to resistance, support, resistance, and then finally it breaks. Off of support. Guys, all you have to do is scroll back a little bit and you will have all the faith you could ever hope for in termination conditions. And I want you to scroll back and look at them, and I want you to believe in them, because rule number 2 is the most broken rule, and rule number 2 is the most reasons for avoidable losses. There's just no reason to take that trade into their decision-making point. Let it break. Let it roll. Let it do something other than be at that area. So if price reaches resistance, the triggers are below, absolutely no trades into it. Same as support. If this area of resistance reverses the market, large triggers go from green to red. That's what we call a strong top, guys. And a strong top means that the decisions made at that key area were so impactful that they completely reverse the direction of the market. Or the decisions made at that area of support were so important to the buyers that they completely reverse the market. A strong top or bottom is the precursor to the highest probability trend trade you can take. It's not mandatory, but it is the warm fuzzies that we really look for. A strong top or bottom is rule one for about 3 trades that you guys are going to learn as you grow with the software. So when you get that strong top or bottom, not only did you not lose money into the area, but you're also going to set yourself up for the best of the best going the other direction. Is everybody good with that? I think the live market really paints the picture, guys. How important are termination conditions? Unbelievably important. We're going to find our money in between them. We're going to find our money not trading into lines, but rather trading to lines, trading from lines. Because areas break all day long, guys, and this is the life cycle of resistance. I want to show you this. When an area breaks, there are 3 scenarios. The first one is that price reached that area and the triggers are still below, and I choose to sit on my hands. I choose to do nothing. I choose to not hope it breaks, but I'm going to let my triggers tell me whether or not it has the potential or it's actually broken. Once price hits the area, we are done with price. This is an important lesson. Everything goes to the triggers. Triggers below, termination, there's a stop sign, don't take the trade. Guys, if your small triggers absolutely smash through the area with that momentum, those scissors open, but your large triggers are lagging behind a little bit, this is a look that lets me know that that area has the potential to break, and I can actually trade based on that potential, but I don't have a clear path yet, so I may have to manage a little more assertively. And once my small triggers and my large triggers get north of resistance, guys, once both lines of both triggers get above that area, my path is clear. I have carte blanche. I have that momentum. I have my clear path. I'm going to look for my entry. What you'll notice is that when resistance breaks, it will behave as support. It does the opposite reaction there. So in a downtrend, price reaches Fibonacci resistance, the triggers are above. Guys, easiest way to not throw my money out the window is to do absolutely nothing, to sit on my hands, to wait and see, is it going to roll and give me a strong bottom? Is it going to break and give me some opportunities? I'm just going to do nothing. I don't want to be caught up in that decision-making process. With all that momentum and the small smash, large lag, there's that potential to break. That's going to be the second trade that I give you a plan for. But guys, your highest chance of success comes from letting the smalls and large, both lines of each, get below support. And you'll notice that it begins to behave as resistance. And once again, let's just illustrate that. Very often you'll see the market break and pull right back to the fib, and it breaks and pulls back to the fib, and it breaks and it retraces. And you're going to see this over and over and over, guys. And that market loves to repeat itself. That's how we find all this success. Perfect termination, potential to break but didn't, potential to break but didn't, potential, 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 and eventually it breaks, and eventually we get a clear path, and then we start the cycle over. Our job is to find our opportunities in between the areas. And guys, look at that. Look at that indecision. I love it when the market gives me such amazing examples. Is everybody good? Can you give me a why? Guys, I love the feedback. It lets me know that I need to move on to the next lesson, or that I need to backpedal and talk a little more. When price reaches an area, let's look for our triggers to tell us what we need to be doing. And here is the patience piece, guys. There will be times when it's fib after fib after fib, when it's fib one-to-one divergence, when your areas are stacked and you can't seem to get a clear path. And your brain is going to tell you, you're never going to make any money with these stacked areas. Take a chance. Blue Pearl, there's too much support. You're going to have to trade into it. You'll never make your money. And guys, this is your 90%. This is the sit on the hands. This is avoidable losses. You don't have to choose to trade into these areas. The futures markets trade billions every day, guys. Billions every day. It's not necessary to be in every move. You don't have to be the first one in. You don't have to be the last one out. Wait for your opportunity. Wait for momentum and path, guys. Find a way to capitalize. Take your profits at these lines. Don't enter your position at these lines. That's going to be the easiest way for you to get to where you want to be. What's this picture? I lost everything, guys, so my PowerPoint's a little changed up. Here we go. Look at this. Fibonacci gives you the ability to see where the driving forces of the market are likely to make decisions. What a gift. What an advantage. Very often, rule number 2 can keep you out of consolidation and chop, guys. 90% of your day is waiting for advantages. 10% will be based on trading from those advantages. This is the September contract of the S&P. Look at how rule number 2 keeps you out of problems. This is right now. Look how rule number 2 keeps you out of consolidation, keeps you out of chop, keeps you out of things that are going to separate you from your money. Guys, it is absolutely amazing once you learn this recipe and learn to believe in it. So, rule number 1 says strong triggers, the advantage of momentum. Yes, I've got it. Life is good. This is a market that's likely to continue in the direction of the trend. Rule number 2 says no termination conditions. I'm not trading into an area that may stop the market, create an untradeable bounce, could actually reverse it completely. And guys, when I have momentum and clear path, it's time to look for an entry. It's time to go to that small chart. The large chart has done everything that I need it to do. It is now in my rear view mirror. And I go to my small chart and I'm looking for my great entry. And I see 3 divergences, 3 losses of momentum in the same price range. Guys, 3 divergences is the only termination condition on a small chart. 3 divergences is the only time on a small chart rule number 2 isn't true. Because remember, the small chart will show us the change that we can't see on that big, slow, large chart. 3 losses of momentum in the same price range on a small chart may terminate the trend. And guys, it becomes even more powerful when your triggers go from strong to weak. When you lose that momentum look and you have 3 divergences. And it's even more powerful if that final pivot is higher than the previous from a low or lower than the previous from a high, creates a little head and shoulders pattern there. So this is the only time I will choose not to take that high probability trend trade. Bouncing off a fib or a 1-to-1, don't care. 1 divergence, 2 divergence, doesn't faze me. 3 divergences is the only time I choose to skip that entry on the highest probability trend trade, rules met large chart from the small chart. But if it's not there, let's use some precision, guys. Let's get into the market. Let's get in right where it's most likely to continue. We are going to be so specific, so precise, so accurate with our entries, guys, that we're going to wait for the market to come to us. We're going to use a limit order to buy or sell a pullback, that little retracement that the small crowd creates, and we're going to do it at an area. We're going to use fibs, midbands, and yellow 1-to-1s, and we will insist that they are inside of triggers. We will demand that they are inside of triggers. When does divergence go away from the count? Great question, Wayne. Let me show you an example. Thank you for asking that. Ooh, I have to reload my data on this one. This is my Monday chart. So what we're going to do, Wayne, is we're going to use the same idea of termination conditions when we talk about these divergence lines, which means that, get over there, hold on. Bum, 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 bum. I'm trying to get my darn, there it is. Sorry, it took me a second. So if this blue fib, Wayne, is my divergence line, that divergence line is broken and out of the equation when my small triggers and my large triggers get below it. And if this red line is my divergence line, that divergence line is broken once my small and large get above it and my count resets. So you'll notice First divergence, small and large can't break it. Second divergence, small and large don't break it. Third divergence, I now have a termination condition. Does that make sense? Does that help? And let's see if we can find a real-world example, because I'm all about real-world examples. Well, there's 3 divergences. None of them broke and the market pushed up. That's kind of cool. There's a divergence line, Wayne. Small and large got below it. Yeah, so Wayne, you can have divergences all over the place. And I'm looking for an example of what you're talking about. 3 divergences, it gets below and resets. 2 divergences, it gets below and resets. 3, 4 divergences, it pushes up into 3 divergences, then it comes down. Triggers never break it, and it starts to rattle and starts to bounce. So yeah, if this is my first divergence and the market just keeps going down, well, who cares about it, right? But there's a divergence to the upside. Small and large got above, so that becomes my first divergence. Does that make sense? Same thing as areas. So if you can't get your triggers above or below those divergence lines, well, then they're in the same price range, which means that they may behave as a termination. Did that help? Sometimes I say things, guys, and I think it's crystal clear, but maybe it's not. Don't ever be afraid to tell me, Mark, I need you to go back and say that again. You messed it up. I do that sometimes. All right, strong silence. I like that. So we'll go to areas inside of triggers, guys. Let's talk. Wayne, is that an example for what we're talking about, or is that a trade that you want me to review in the second hour? Okay. Guys, if you ever post something that is per the lesson, go, hey, like this, with a question mark. 2 divergences, right? Smalls and large get above. So that's your first divergence. That would be your second divergence. Perfect example. There's the first divergence line. It doesn't get broken. There's the second divergence line. Right here it's broken. So that's going to qualify as your first divergence. Yeah, good stuff. That big red fib, you didn't even need the divergences at that point, right? Good stuff. Great question. Thanks, Wayne. I like when we clarify. So guys, we're going to use a limit order to buy or sell a pullback at an area inside of triggers. Why do we use the triggers? I love to talk about this. There's this phenomenon that happens on every time frame, every chart that you're looking at, guys. And price tends to return to the large triggers. It's a moving average. So if price pulls away, it tends to pull back to the large triggers on the small chart. But it's not just the small chart. If price pulls away, it tends to return to the large triggers on the large chart. So in Nexgen's infinite wisdom, we put the large triggers from the large chart onto the small chart as well. We call them synthetic triggers. Anytime we pull something from a time frame and put it on a different one, it's called synthetic. So your small chart, your entry chart, will have large triggers. They're smooth. You can use these with the small triggers to define momentum. And then it'll have these synthetic triggers, which are just the large triggers from your large chart. Your large and synthetic define where the retracement is most likely to go. Your large and synthetic will define, let me pull this picture up, where the small crowd, where the retracement that they create is most likely to go. So when these triggers are split from one another, the area for retracement is bigger, which is why for new users, we have this look called favorable large triggers, guys. And favorable large triggers are wide, and they are in the direction of the trend. And favorable large triggers mean that your large and synthetic are overlapping, one on top of each other, like 2 snakes riding piggyback. And what that does for you is it gives you the smallest zone where the retracement is most likely to go. And then when you shoehorn some areas inside, fibs, midbands, yellow 1-to-1s, you give that price something to bounce off of. So trigger lines define where the retracement is most likely to happen. Areas in that zone, in that retracement zone, fibs, mid-bands, yellow 1-to-1s, these define where the market is most likely to bounce. So the bigger the trigger gap, the bigger the zone. The more areas, the bigger the zone. But the tighter the triggers, the tighter the zone, the least amount of risk, the higher the accuracy, guys. So this is how we're going to define an entry. Is everyone with me so far? Large chart leads the way. Momentum and path. This is in place. And your small chart will be screaming to the upside. Your small chart will be flying to the upside. And your little fear of missing out gnome that sits on your shoulder is going to tell you, hey, L, you better just jump in, brother. They're not coming for you. Blue Pearl, pull the trigger. They're never coming back for you. Steve, dude, get in. They're not going to make it back, not to an area inside of favorable large triggers. And that's what your brain's going to tell you until you study this a little bit. But guys, they almost always come back. More often than not, they come back. And it begins with a reversal bar. It begins with a down bar after all of those up bars. And if you made the mistake, if you got tempted and you jumped in, this reversal bar says, hey, 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 exit that position. Let's wait for the trend trade, guys. So at the time of the reversal bar, we're going to do a couple things. First, we're going to find those triggers, large and synthetic. You can put a box around them, and that box will define where these price bars are most likely to retrace. But the triggers aren't my entry, right? They just define the retracement level. The areas inside, fibs, mid-bands, and yellow 1-to-1s, these are something solid for the market to bounce off of. So that retracement comes to the triggers, but I anticipate the mid-band creating a bounce. And it comes to these triggers, and it might be those 1-to-1s that make a bounce, and I don't know which one it's going to be. I'll never know. But I do know that from my highest point of support to my lowest point of support, inside, all caps, inside of triggers, is precisely where the market is most likely to continue. It is almost exactly where the small crowd is most likely to fail. And guys, you're going to activate a limit order 2 ticks above that highest point of support, because the large chart has the best look on momentum you could ever hope for. And the large chart has absolutely nothing in the way to create a bounce. And this small chart is nothing more than a refinement chart. Inside of that one bar on the large chart, we're seeing an entire retracement as well as continuation if it continues. This is your entry for the highest probability trend trade long. And because you know now where the market is most likely to continue, you can define where the market shouldn't go. Any line on the wrong side of the triggers, any line below the retracement point, guys, this is not a part of the window of opportunity. This is not a part of the equation. This is where the market shouldn't go. We don't want to try to get in down here. Our entries come from the highest point of support. In a downtrend, large chart says down. Large chart has momentum. Large chart has a clear path. Small chart is rocketing down. You have to squash that desire to be in every move. You wait for the reversal bar, the up bar, after all of the down bars. And this reversal bar says, all right, Blue Pearl, let's find those triggers, large and synthetic. Are they overlapping? Because this is where the market is most likely to return when it retraces. And then you'll say to yourself, those triggers aren't my entry. Where are my areas inside of triggers, guys? And this is a magical moment. There is one line, a mid-band, inside of triggers. One line. And that line represents where the market is most likely to continue, guys. That mid-band is where the market is most likely to bounce. I just kicked a soccer ball as hard as I could. I don't expect the triggers to stop it. I expect the area inside of triggers to give me that equal and opposite reaction, guys. 2 ticks below because of the momentum and clear path on the large chart. This is where your limit order will be. You will literally wait for the small crowd to come to you, and then you'll enter that trade. And you know that any of these lines on the wrong side of the triggers beyond that retracement zone, guys, those aren't where the market should go. If this is going to be that 70 to 80%, that's where the market should not go. And any fib, mid-band, 1-to-1 on the wrong side of the triggers, that's not your entry, because once you get north of these triggers, you just don't know where it's most likely to stop. And once you get south of these triggers, You just don't know where the market is most likely to stop. So we take that concept and we work it into management. Your initial stop is going to be placed where the market should not go, typically 4 to 5 ticks above all the trigger lines for a short, below all the trigger lines for a long. And guys, the classroom verbiage is, we call this the window of opportunity. And once the market blows through it and gets beyond those triggers, your advantage is gone. You don't want to be in this trade. You need to be willing to lose 2 or 3 out of every 10 of these high probability trend trades. It's a cost of doing business. It's a normal part of a positive equity curve. But the great thing is with all those advantages, you're more likely to get a bounce off the area inside of favorable large triggers. You're more likely to get a reversal bar in the direction of your trend. And this is where you're going to reduce risk. This is where Nexgen users find themselves with $20, $30, $40 of risk per contract instead of $150 at that initial stop, guys. That's going to be your first stop movement when you recognize those advantages. So, learning the pattern. How do I learn the pattern, Mark? The market moves too fast. I'm scared. I don't want to lose money, even on simulator. Guys, you don't have to be in a trade to become a great trader, or at least a great chart reader. You want the live reps, but you can scroll back on a large chart, and anytime you see that one bar endeavor with strong triggers, with either the potential to break or that broken area, put a circle on the tail. Remember, the tail, that's the inner workings on that small chart. That's your pullback on the small chart. And if that tail, guys, give me a Y if you can hear me, please. All right, thank you, thank you, thank you. Cool. So guys, if you ever can't hear me, make sure that you tell me. And then if you see 20 Ys afterwards, it means that everyone else can. Thank you for throwing the yes in there, guys. This is how I'm going to study. I'm going to go back and circle tails on my large chart, guys. I'm going to go back. I'm not going to do it on the NASDAQ because the NASDAQ is absolutely psycho. So let me go to, boom, 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 boom. Let's go to crude oil real quick. And anytime I see momentum and path and one of those tails, I'm going to circle it. And not all of them are going to be trades, guys. Not all of these are going to be high probability trend trades. That one didn't quite make it to the area. Just Discord. Hold on. There we go. You'll see that not all of these are going to be high probability trend trades. Not every tail is an entry. Not every clear path is an opportunity. Remember, it's patience. But if I do go back and circle one of those tails, I can scroll back on this chart, and there's the first pullback, right to support, right on top of the large triggers. One second, guys. One second. All right, guys. I'll always try to get you there. And I send a note to the salespeople too. They'll probably come help you. There we go. There we go. There we go. Do you guys see that it came right to support? It's in between the retracement zone. It's right at the areas that bounce. It never got below. And look at where the tails line up. Guys, this is how you're going to study. And you can go back on any market you have a workspace for. And you can see those looks. And you can circle those tails. And you can just come back on the small chart. Whoops. If I can find my small chart. And you can say, where is that tail? What's it look like? Did I have rules met? Is that my pattern? And guys, sure enough, that is all that momentum with the potential to break. Do you see how it came right back to the lowest point of resistance right there inside of those synthetic triggers? I'm not saying anything, Pete. Can you hear me now? Guys, can you hear me? Give me a Y, please. Is it me or is it Discord? Okay. It happens sometimes. Discord is just a computer program. Every now and then, stuff goes wrong. So when I have that problem, guys, I open up my task manager and I go to Discord and I end that task. So we'll see if we get that. This is typically the best way to do it because what it does is it tells Discord to go to hell. Stop, you're done, no more. You don't even exist in my realm. And then when you reopen it, typically, it works. Guys, this is it. That's your pattern once again. So that's two different markets, same pattern, same result, easy money. So one of the things that I say to you guys every morning, and I say it a little cocky, is that you'll get everything that you need. Everything that you need to be successful with the software. So we learned the trigger line and the Fibonacci rules for when it's okay to trade, guys. We broke them down individually. We talked about what they mean to you. We talked about where to find them. So now you have something to study. You have the ability to simulate. You can practice over and over. Absolutely no fear of loss. Doesn't matter. We're just practicing. Awesome. Steve, sometimes I'm pretty good at this stuff. Every now and then. It's weird. I don't know why Discord does it, but it does it every now and then. And so we find fixes for everything, right? You guys can simulate, you can practice, you can post in the room, you can get feedback on everything that you need. You have the spreadsheet, which means that you not only have access to over 350 pictures of trades being taken using momentum, path, and entry. You have a place to put your study. You have a place to learn how to recognize the individual rules, to look at the client's trades, to build your own plan, to track. So now I'm going to give you the stuff that's going to get you to where you want to be the fastest, guys. And I'm going to tell you right now, work is a 4-letter word for most people that want to trade. And of course, I'm not accusing any of you of this. But the people that come to me that want to be day traders fancy themselves alpha males, alpha females. I'm the person in charge, Mark. I'm not the student. I have the answers. And guys, that mentality kills more aspiring traders. You've got to put yourself back into kindergarten. You got to put yourself back into that freshman year of college, guys, and do the work to build the foundation so that you can be good at this. So, chart reading 101, in order to get to where you want to be, you have to be able to recognize these looks. And guys, you got to be able to recognize them quickly because the market's moving and it doesn't wait for you. So by taking 25 pictures each of strong triggers and weak triggers, of a clear path and terminations of those high probability trend trade entries, what you're doing is you're burning that look into your brain. This is what it looks like to have my rules met. So much so that you'll be able to open up your large chart and at a moment's notice, you'll be able to say to yourself, colors don't match, don't have strength. Boom. And then you're done. And then that's it. And you're like, well, crap, no trade. You've got to go through this process, but you can't just take pictures and expect them to magically make you brilliant, guys. You've got to type. You've got to type on those charts. You've got to annotate these pictures. So when you go take a picture of strong triggers, what are we doing here? You have to, boom, 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 right on there. Rule met, smalls above large, wide in the direction of the trend. This is strong triggers. This is rule number 1 met. So now not only do you know exactly what the look is, you know precisely what it means to you as a day trader. You begin to speak to yourself in terms of advantages. So this is the easiest way to get to where you want to be. On Friday, I gave this out and suggested that a lot of you go through and take 5 of each of these. Dollars to donuts, nobody did it because it's not fun. Studying's not fun, guys. I know it's not. But this is going to get you to where you want to be. So if you decide to try it, here's the high probability trend trade checklist. And this shows you what it looks like to have your rules met. Because I don't want you going, oh, I'll take all these pictures of triggers and I assume that they're strong, right? So is the market coming from a strong top or bottom? Not mandatory, but that's what gives us that best of the best. It's a no triggers through termination that reverses the market, and that's the highest probability trend trade you can take. But it takes momentum. There it is, up and down. And then there's weakness. Pretty easy to gauge the difference. That's your termination. Tells you why. Not broken. No clear path. Smalls above, large below. With momentum has the potential. Small and large through. The area is broken. There's no reason to accidentally trade into areas if you spend the time studying exactly what you're looking for. Why, where your order goes, where the market should not go. All of that's there for you as you go and take those pictures. And then I'm also giving you the high probability trend trade checklist. Print this out, laminate it, get a dry erase marker, and police yourself. Every time you take a trade, make sure you have the advantages. Write these phrases on your chart as you police yourself to make sure you're taking the best of the best. And I'm going to tell you right now, nobody in the history of this checklist, as long as I've had this checklist and been giving it away, nobody has ever done worse than 70% by following it. And in the history of it, and I ask people all the time, where are you at? Where are you at? And I tell people, if you can't hit 70% with this checklist, well, then you don't understand the checklist. Let's work together and let's make sure that we fix that. So 70% winners, guys, think about that. That's pretty outstanding. And the goal is to win more than we lose, which is why I also give you the KISS plan, guys. The KISS plan. This is a stepping stone in your learning journey. It's designed to optimize your chances of success with a high probability trend trade as a new user. This is the plan that has been proven to win more than it loses. This is the plan that teaches you to read your indicators. This is the plan that puts you into the market where the market is most likely to continue, guys. And then through simulation, study, class feedback, and continuous practice, you'll be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. Guys, when you can read your charts, you're going to see more. Ron's not in here today, but Ron used to always tell the kids, and that's what he likes to call you guys. Guys, this is not your get-rich trade. This is the trade that when you understand it, when you can read your charts, when you identify advantages, this is the trade that teaches you to see your get-rich trade. This is the trade that teaches you to manage your trades. This is the trade that teaches you to understand advantages and to learn to trust them. And your simple plan for consistency, Don't fight the large chart, guys. Don't fight the large crowd. If it says up, don't go down. If it says strong up, definitely don't go down. If it has a line that fits the description as a termination condition, there's no reason for you to trade into it. You know better, or you will. So define your entries. We just spent almost an hour defining how to get into the market for the high probability trend trade. Why? Because great entries create manageable trades. Because great entries reduce risk. They maximize profit potential, guys. And then once you're in that trade, you've got to do something with it. Once you're in that trade, you've got to manage it. Management, for me, maybe not you. You guys are probably braver than me. Management is where I got terrified. Management is where my palms got sweaty. Management is where my fear of giving it back just gnawed at me until I exited that position, guys. So what I found, is that if you keep your management every bit as mechanical, every bit as if-then, it's a flow chart, the same way your entry is a flow chart. Jim B, if you're in here, thank you for that. If-then, it's going to help remove the emotion. It's going to help keep you from making bad decisions based on your emotions, guys. So your management plan is every bit as mechanical as your entry, and you'll create a different management plan as you learn to read your indicators. But in the KISS plan, it is 100% dependent on your ability to enter the market where the market is most likely to continue. And this KISS plan is based on 2 contracts, and it's designed to teach you stop placement, and it's designed to get you paid, because that's the goal of trading, guys. And the KISS plan is going to help you realize that it doesn't take a $500 trade every time you pull the trigger to be successful. If you are in where the market is most likely to continue, that's my if. Then my stop goes 5 ticks below those trigger lines. And at this point, there's nothing to do. Sit on your hands, put them on your head, do anything other than adjust your stops. You're going to have preset targets, but right here, 20 to 30% of the time, you're going to get hit. You got to be okay with that. It's a cost of doing business. But more often than not, you're going to get a reversal bar in the direction of your trade. So if I get a reversal bar in the direction of the trade, then my new stop is 2 ticks below that reversal bar. That's it. Not right up on the reversal bar, not 2 ticks below where price is trading. 2 ticks below, because the market has gone down. It has bounced. It said, hey, guess what, Mark? We're doing everything you hoped would happen. Reduce your risk. And now I'm either going to get stopped out for a tiny little loss, doesn't faze me, doesn't scare me, doesn't worry me, I'm okay. Small losses are a normal part of a positive equity curve. Or that first contract, we're going up. We're going up to the first target. Your first target in the KISS plan is $100 away from your amazing entry, guys. 8 ticks on the S&P. Tick is the smallest increment that the market moves. 8 ticks on the S&P, 10 ticks on crude oil. And if it hits that first target, 1 contract comes off and $100 goes into your account. $100. Boom, you're a winner. You did it. You took the right entry. You managed it appropriately. And you just made $100. If it hits my first target, then my stop placement is at break even. Now I have nothing to lose. As I hope that it goes to my second target. And here's the deal. The only reason I'm in is because of momentum. The only reason I'm in is because of a clear path. And more often than not, that thing's going to scream up than just change directions. So that break even, where'd it go? That break even gives me the courage to hold. I've got nothing to lose. I've got money in the bank. My sweaty palms are no longer sweaty. And I'm either going to get stopped out break even, guys, and it's going to happen. This may not be the best stop ever. And you will craft a plan tailored to your personal goals based on your ability reading the indicators. But if that doesn't get hit and it goes to my second target, that's a $300 trade. I'm only $200 away from that amazing entry with every advantage that I could hope for, guys. And a $300 trade, if that's the best you do every day, is a $75,000 year, guys. Take a second trade, let it go break even. Now you're looking at 6 figures at $400 a day. This is why we don't have to be in every move. We want to be in the best moves. And There's no doubt in my mind, and I say this with the utmost confidence. If you learn momentum, path in that first entry, you'll see the potential for the $400 almost instantly. It may take a little practice to get to it consistently, but you're going to know that it's there, and that's that carrot at the end of the stick, because you know that it's possible and you know that it works, and all you have to do is figure out how to work it, to find your patterns, to feel good about it, to build that confidence, right? Next-gen software is like the world's greatest elliptical, but if I don't haul my fat butt up on there, I'm not going to get to where I want to be. I got to do the work to get to where I want to be. So I told you guys I'd give you everything that you need. I did that. You have it. I'm going to put it in a zip file right here. Everything you need. It says it right on the zip file. And guys, inside of that zip file is Chart Reading 101, reminding you that you need to learn these looks. Inside of that zip file is the checklist and what it looks like to have the rules met. Inside of that file is the KISS plan, that first trade designed to get you into the market and get you paid. And then the second page is that potential to break trade. But guys, you've got to understand the lessons from the high probability trend trade to be able to capitalize on this one, because you need to be able to recognize a strong top or bottom. You have to be able to recognize odds favorable momentum. You have to know that it's not a clear path, which is why we're not going to sacrifice momentum. No divergence on the 5-1. And that's so important that it says it again. And it's so important that it shows up in management, because management is different for a 50-50 trade than it is for a high probability trend trade. You're also going to get this bad boy. I love this. This one's called exit conditions. There's two things you have to know before you get off of that simulator and try to do it for real. You need to know why you will enter a trade. And the rules or patterns proven to win more than they lose, those are your entry rules, guys. That's why you'll enter a trade. And you have to know why you'll exit a trade. And you'll exit a trade when your advantage is gone. Maybe it's going 5 ticks beyond the triggers. Maybe it's 3 divergences printing in the same location. But your rules help remove the emotion. When your rules are met, you're trading a pattern that's been proven to win more than it loses. You don't have to worry about what's going to happen. You don't have to try to guess whether it'll win or lose. You only have to be consistent on the execution, because the execution yields results. So if I'm in a high probability trend trade, I've got a solid plan to take it. And in the beginning, I've got a solid plan to get out of it. And then there will be more opportunities. The 50-50, different rules, different management, momentum trades, HVA trades, white bar trades. There's so many trades that you can take with the software, and they all enter and exit differently. So guys, that's everything that I give in the first hour. Every rule that we teach for the high probability trend trade, right? All the ways to study it, all the places to put your study on the spreadsheet, what it looks like everywhere. Are there any questions? That's our first hour, guys, and now I stand up and take a break, because nobody should sit in a chair for that long. My legs go numb. All good, quiet class. I love it. When I come back, we're going to look at pictures that were posted. And guys, I've got like 5 pictures posted, which means I'm going to have to rattle stuff off for nearly 2 hours to try and entertain you. My job will be 1,000 times easier if you do me the pleasure of asking questions. Ask me questions. Make me clarify. Take pictures of charts. If you've never taken a picture and dropped it in this room, guys, when I come back from break, I want to see a picture. You guys get TechSmith Capture when you download the software. And TechSmith Capture, why is that not working? I may need to re-download it. TechSmith Capture is how we're going to have a conversation. TechSmith Capture or Snagit, if you have Snagit or whatever tool you have. Guys, this is what we need so that we can talk, so that you can post in the room. And Paul said, check it out, Mark. It's a bad bottom. It's not a strong bottom. The triggers got through. It's a 50-50. I don't have a clear path. It's only the potential to break. My rules say this is a very avoidable loser. Paul, great job. And guys, notice that he talked about whether he had a clear path. He could have identified the momentum. And guys, take pictures when your rules aren't met, because what it does is it gets you excited about your rules. Paul, great job. Thank you for sharing that. That was very timely. But every picture you guys drop in the room, guys, we're going to go through it just like that. We're going to talk about what you saw. We're going to talk about the advantages that were present, the advantages that were gone. If you have an entry, we'll make sure that it was the lowest risk entry. If you have an exit, we'll make sure it was the highest profit. So I'll be back in 5 minutes. Talk amongst yourselves, post a picture, ask All right, let's start the second hour with this right here. Did anyone notice that giant bounce that came right off of that blue fib and yellow 1-to-1s that the triggers didn't go through? I'm going to tell you guys right now, whether you're supplementing what you're already doing, why? Why would you ever trade into that, right, Bob? No reason. I love this. And if you were in a short position, you knew where to take profits. I get excited, guys, when Fibonacci comes together like that, because it went from fib to fib. That's the long trade Paul avoided, and look what happened coming down. And maybe there wasn't an entry there. Maybe there wasn't a way to get paid there for you yet. And I think yet is the key word. So I'm going to scroll up to the very top, make sure that YouTube is going, and we're going to look at some pictures, guys. Joel got us started, and Joel says, check it out. I have odds favorable momentum, and it's one of those 50-50 trades, only the potential to break. And guys, I want to remind you, we all do, Rob. We all do, unfortunately. I had that talk with a friend of mine this weekend. I made like 4 mistakes in a row trading in determination conditions, hoping they would break because I stopped thinking about the process and started thinking about the money, and that just never works. So guys, this is one of those 50-50 trades, one of those area not broken trades, but with all that momentum, it has the potential to break. Joel takes a good looking entry at the highest point of resistance because he's like, man, if it's only 50-50, I don't want a lot of risk. Hey, Reverend Bobby Baker. He takes quick profits because it's not a high probability trade. He gets out break even on the second. And guys, that's nice execution on a 50-50 trade. On a trade that failed, he was still able to get paid, to make money. And the more in line you get with your indicators, guys, the more aggressive and assertive you can be with your management on not perfect trades. Here's one that had momentum. It's the very tail end of it. There was room to the target, and that mid-band was sitting right on top of the triggers. And because it's on the wrong side, there's a little bigger retracement there. He gets in, and he rides momentum, and then when momentum goes away, he exits once again, taking a little something from nothing. Joel, nice trading. I'm a trend trader just like you guys, and look at this, I'm human just like you guys. I got a little jumpy. I missed my best entry, and it put me with too much risk. They took me out. I had to get back in. This is the NASDAQ. It's a little different entry. Profits just turns into another trend trade. Second contract, guys. That was a pretty easy $650 trade. I took this one too because when there's nothing for me to do, I take pictures of it. When I'm looking at my charts and I say, man, my rules aren't met. I don't have a clear path. My momentum isn't there. I could sit there and try to talk myself into a trade, justify why I could take that trade, or I can take a picture of it and say, wow, I don't have an advantage. Let me sit on my hands. Let me wait for that advantage. And guys, I'm telling you, I probably take more pictures of no trades than I do actual trades. Because 90% of my day is being patient. 90% of my day is waiting. All right, who gets to be next? Irish M. Casey. I just call you Marty. Odds favorable momentum. Price and triggers clear. Jump in, jump out. Chili dog. The chili dog trade. A lot of you guys see this. And when I'm teaching rules, when I'm talking about advantages, I make a point of reminding you guys that once you have momentum, once you understand path, you'll find a way to get paid. And Marty taking the reins from Ron right here, that's a fast $240, guys. That is in seconds probably, 5 to 10 seconds with momentum, with path. And because he's not waiting for that pullback, he's not waiting for that fight by the small crowd, you'll notice that his entry is fast and his exit is just as fast. It's let me get in, let me get out before anything changes. I love this trade. Great job, Marty. I used to avoid this trade like the plague in the room, guys, but now there's so many of you taking it. I love it. And look at this. Same thing. And then, let's see where we're at. Weak top, strong triggers, 74. You are trading into a divergence low. But you said, you know what? Let's do it quick. Half off. Was making coffee when this happened. It hit your target but didn't fill. Oh no. But with all that momentum, they still pushed down. Great trade, Pete. Great trade. And you want to talk about confidence in your trading plan? Was making coffee when this happened. Want to talk about confidence in your trading plan? Because I'm a chart reader, I understand where the market is most likely to go, and I'll go make coffee until it gets there. That's pretty awesome, Pete. That Florida sun doing you good. All right, Wayne with the trifecta here. Let's start on the first one. We'll kill some tabs, save some resources. And guys, I'm okay with you posting 3-4 trades in here. Doesn't faze me a bit. I like it when you guys do this. So let's check it out. Odds favorable momentum? No. It's just not. It's just not odds favorable momentum. But what it is here, ladies and gentlemen, and Wayne knows this, 30 bars in the same direction, breaking 3 or more areas, no reversal bars. This is what we call a strong trending market. 30 bars in the same direction on your large chart without a reversal bar, that's a strong trending market. And when you have a strong trending market, you'll notice that your small triggers will ride those large triggers. Just like that, just like you see there. This is the next step in identifying momentum. Let me go back to the lesson real quick. From the trading guide. And when we go to momentum, trend and direction, whoops, that's it right there. That's that strong trending market. And there's not separation between the small and the large the way it's taught in the room, that very basic remedial 101 approach to momentum. But 30 bars in the same direction without a reversal bar, 3 or more areas broken. This is your first chart, Wayne. That is strong trending market. And when you have a strong trending market, you just go on the assumptive that you do have the momentum that you need to push that market. Wayne, you absolutely had a clear path. And this is interesting. Had a clear path, trading into term with momentum. Which it can't be both, right? You've got strong trending, railroad tracks, you've got a clear path, and the general consensus is when you have a strong trending market and nothing in the way, is sell that mid-band till it stops working. But price has nothing to do with it, does it, Wayne? Guys, this is why I'm so clear in my language when we talk about identifying a termination condition. This is why. Has nothing to do with it. So price reached the area, right? Check this out. Same recipe, Wayne. Price reached the area on the retracement. All the triggers are below it. That's a termination condition. That's how we teach it. The same way, when price reached these one-to-ones and all the triggers were below, the one-to-ones were a termination. And when price retraced to that resistance and all the triggers are low, each of these lines were an area likely to stop the market. And that's exactly what it did. Right at your mid-band, right at that fib, and boom, down it goes. Great job. So price getting to the fib sets off the is it a termination, and then the triggers let you know whether or not it is. Does that make sense? And this is for everybody, not just Wayne. But with that strong trending market, you nailed it. And I love that you didn't nail it on the way up. You said, let me make them go down a little bit. Let them get to that area. Let's make sure that they really want to have a little bit of a fight, and I'll catch them on the way down. And then that was beautiful. Absolutely beautifully done. I love everything about this trade and everything that went into it. And then here we go again. Odds favorable, clear path, no areas inside of favorable large triggers. Wayne knows that once you get to the wrong side of the triggers, it might be the mid band, it could be the fib. Hell, it might be the fib all the way up here. Wayne says, look at these triggers below, and you may want to reload historical data. And he catches it on the way down. Nice trade, Wayne. Good one. Yeah, you definitely want to reload your historical data or hit F5. Look at how your trigger lines are just crazy. I was the kid with the lazy eye, is what my face looked like on most days. Absolutely no gap theory. And we can talk about why. So the gap theory, and guys, this is when, and let me go back and let's do the full lesson, because you start with gap theory. And guys, this is one of the ways that the classroom is going to work. Your annotations let me know what I need to talk about. Your annotations let me know lessons that need to be revisited. So termination conditions defined, and the way this one's going to come in is the gap theory lets us know when the large chart midband is a termination condition. And it does that. Let me pull this off to the side so I can grab some pictures. But it does that because the gap theory states that when price accelerates away from the large triggers, synth means large, too fast and too far into a Fibonacci area, it typically snaps back to the triggers. And Wayne, I think what you did here is you decided that your small triggers were your snapback. I don't know if the large triggers were a full bar away. Maybe they were. And you went long, and that's aggressive, and that's cool, no worries. So now I see what you did. Wayne says I hit support, the large triggers were up here. Let's see if it pulls back. Okay, that's actually really pretty. I apologize. I looked at that the wrong way. And let me show you why he did that. Because when you hit an area and the large triggers are up here, it's likely to snap back. And Wayne said, check it out. Watch me get paid on the snapback. I like it. And it was quick profits right when it hit those small triggers. Great job. And then when everything continues down and that momentum is there and that potential to break is there, you take a little momentum style trade and catch it down. Great trading. Wayne, you've got such a great flow to your trading. And you're so in tune what you're looking for. And it's obvious when you look at your charts. You're getting to the point where it's pretty much the same thing every day. You told me you dropped down to only 2 trades. I see that you're adding them in a little more, but that's okay. When you get comfortable, you can. For sure. All right, Miss Cindy, let's see what you did. I think that's awesome. 2160 is a great day. Cindy, did you have a clear path? You can't, right? Because price reached Fibonacci support and the triggers are above. Do you see it? You're trading directly into a termination condition. And I'm not saying that's a bad thing, but I think it's important to recognize it. When price reaches, that's when the triggers take over. So even though it retraced up to the area inside of triggers, it's still a termination. And if I can be honest with you, to exit when it doesn't break through that termination condition, that's good management, Cindy. And even though it went down, that's pretty good management. That's a hard one to hold through. You've already hit the area. The triggers didn't break. Divergence printed. You had a pivot stop out at fibs. Price heads back up. I don't know that I would have held that trade either. That doesn't look like a market that's trying to go down. That looks like a market that may be trying to change direction right at a key area. So they're not all going to win. And I think you did a good job with that one, even though I know you're not happy that it kept going down. And then Jay, no trades, but I see where you traded. You're saying no long trade. Triggers rolled down from divergence. No short trades because it's into fibs. No trades, weak bottom, reversed out of nowhere. No, it reversed right at a mid-band from a bad top, Jay. Do you see it? They didn't make the key Fibonacci area, and they pulled all the way back to the mid-band and bounced. And then you had odds favorable momentum, and then you had nothing in the way. And this would have been a better look than that even. I think there was an opportunity there based on what you're looking for, Jay. Does that make sense? Can you guys still hear me? You're looking for momentum and a clear path, correct? There's your momentum, triggers above. There's your path, didn't reach divergence. I think that's your opportunity based on what you've been showing me lately. That's the one right there. So let's talk about a pattern that tends to repeat itself a lot. And we're going to take two different lessons here. Let me see if I have a picture of it. All right. So let's open up a large chart. So the first lesson that we're going to take, guys, and this is for everybody, will be the idea of a strong top or bottom. And I'm just looking for the perfect strong top or bottom. Dun, 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 dun. I've probably already missed it. I want just a picture perfect strong top or bottom. All right, so here we go. How do we define a strong top or bottom? Whoops. And this will be a great picture for you guys to put into maybe your spreadsheet if you study. So every strong top or bottom, whoops, has to be a termination condition first. So what's the recipe? Price reaches support, triggers stay above. And Jay, you don't necessarily need the lessons that I'm going through here, but it's a great opportunity to teach some lessons about patterns. This is a termination condition, 100% textbook. And guys, you'll realize that sometimes I turn your great pictures into lessons for everybody. And don't feel like I'm lecturing you, going, man, Jay, you didn't do this, burr, 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 burr. That's not what I'm doing. Right here, I just want to be able to define it because we're going to create some expectations based on patterns. When the large triggers roll from the no triggers through termination, it's now, it's now a strong bottom. So there's a two-part process to defining a strong top or bottom. First, it's a termination, and then once it rolls, I have a strong bottom. Larger moves the opposite direction are more likely after a strong top or bottom. Does that make sense, everybody? This is that one that's not mandatory, but when you get a strong top or bottom, very often you get, whoops, a much larger move after. Wayne says, Mark, check it out. Here's a strong top. Price reaches resistance, none of the triggers break. There's your reversal, absolutely. And then Wayne, you want to show that picture of what happened after the strong top? That market cratered, right? Strong trending. Hold on, we have it. Let me show you guys what happened after the strong top. You already posted in the room. I thought you did. Maybe not. There it is. After that strong top, that was the movement after. Pretty cool, right? So identifying the strong top or bottom is awesome. Now let me show you a pattern that's pretty common when I don't have a strong top or bottom. And this is picture perfect. Guys, I believe pictures pay dividends long term. I really do. So do you guys see how the small and large triggers got above resistance? This is not a strong top if the triggers break. This is a weak top. Can you guys give me a why if you're with me on this one? Guys, I don't have any of your pictures to work with, so we're just making lessons today. This is your weak top. When I have a weak top, the midband and areas near it are more likely to hold. Not guaranteed, but more likely to hold. More likely to stop that market. Because remember, we're not the only ones that know about all these key areas. So this is why when we talk about 50-50 trades, there's your 50-50 trade. Coming from a strong top or bottom is important because the expectation is that we're more likely to see these big moves. But from a weak top, very often, that midband is more likely to hold, and the market is more likely to continue in the direction of the trend. So this is just a pattern, guys. I'm not telling you that this is a trade. This is what John Novak calls unfinished business. Right here, they didn't quite reach the fibs, and the sellers tried to push it down, and the buyer said, nope, we had business up here, and it turns out it was up here at this fib. But what it does is it kind of opens the door right about there to start thinking about going up with that trend. When everything goes green again, it kind of puts you in a position to start saying, wait a minute, I might be able to find a way to get up from that bad top that bounced at the mid-band that now gave me momentum. And Jay, there you go, brother. So this is one of the reasons I love this classroom, is that probably isn't a trade that's even on your radar yet. But because you were willing to post the picture, maybe that trade finds its way under your radar. Maybe you start creating expectations from bad tops and what the reaction may be at the midband and where that thing might go. So great picture, Jay. Thank you for that. There's your bad top. There's your mid-band, the fibs. Failed 50-50, and look at it. Off to the races. Do you guys see it? This is everything we just talked about. Did they want the fib? I don't know. Maybe they did. Maybe they didn't. That's one of those potential to break. Should we get in? I've got momentum. I have the potential to break. I pulled back to the mid-band. Oh, this is NASDAQ. Egads. NASDAQ's fast. I don't even know what my stop placement is here. But that's what it looks like. We'll see if they do it. There's 2 divergences in the same price range. Oh no, 3 divergences in the same price range. It's probably going to come stop me out. But there's that pattern again. There's that pattern one more time. Bad top, failed 50-50. Are they going to go? I don't know. Guys, this is simulator. I'm just learning patterns. Well, my goodness, it looks like they did want that fib. How's that for a lesson, ladies and gentlemen? Steve, you were asking, will we ever get to see it live? There you go. And look at the reaction right off the area. That was $525 in 30 seconds. You thought trouble needed to be further away to be considered a clear path. Thank you. Thank you for saying that, Jay. Let's build another lesson. Are you ready? That's pretty awesome, wasn't it, Kurt? Guys, this is what you're going to be able to do. Once you know your rules, that's exactly what you're going to be able to do. NASDAQ, do you see how fast that was, though? NASDAQ is difficult. And if you get caught up in the shenanigans, it'll terrify you. All right, so we're going to do this. The language for the termination condition says price reaches the area and then it's all up to the triggers. Do you guys remember that? In order to define a termination condition, first price reaches the area and then it's all up to the triggers. Does that make sense, everybody? So the area in question is this blue fib. If I'm in a short position, there's my next area. Does that make sense, everybody? That blue area is still my target. That blue area is still my target. And it continues to be my target until price reaches the area, and now it's a termination condition. Target, term. And that's exactly how you think of it, guys. And if you let it be simple, if you say to yourself, there's no such thing as too close. There's no, well, maybe a tick. But it's not let me decide what's scary and what's not scary. Let me decide what these rules need to be for this particular situation. If you keep it 100% the same thing always, price reaches the area, where are my triggers? And this is a great example. And then Jay, you got the gold star today because you're making everything work out great. So check this out. From the top of this bar to my first trouble, and the top of the bar is right here. Do you see how I have, what, 3 ticks? I have $30 worth of profit. Are you guys with me? I have $30 potential from the beginning of the pullback. From the area inside of favorable large triggers to that same problem, I've got 300, guys. And this is why buying or selling pullbacks increases profit potential. And this is why buying and selling pullbacks reduces risk. Once I get that reversal bar, I've got virtually no risk, and I've got all of this room to get to my targets. But if I look at my large chart, and I'm guilty of this, guys, I am so guilty of this, and I say to myself, damn it, that's not enough room to make any money, it means that I don't remember that my entries don't come from the top of that bar, they come from the pullback to support inside of triggers. Look how my synthetic triggers defined where the pullback was most likely to happen. Look how my large and synthetic triggers work together with areas inside to pinpoint right where that pullback was most likely to happen. And once you trust your methodology, guys, look at how much profit potential there was to get back to that area. So, Jay, once again, I appreciate that you said that. I appreciate that you said, I didn't think there was enough room. Now it's a term, right? Now it's a termination condition. Jay, if you took your shot somewhere over here, you had plenty of room to make money. Uh-oh, wrong one. Sorry. Careful when you push buttons. That was an accident. I've got no room to my termination. But from down here, I may have. There's one of Wayne's trades. And this is why we talk about advantages. You guys will dig this. So do I have momentum on the large chart? What do you guys think? Right where I circled that tail. Does everybody see that I had momentum? Does everybody see that I did in fact have a clear path? No, that's a totally clear path, Wayne, 100%. Smalls and large are above the fib. Well, Jay, that's because if you're just taking a shot, you're not following rules. There's a big difference between taking a shot and following your plan, right? And if your plan isn't so specific that it leaves room for taking shots, that's not a very precise plan. So guys, just by clinical definition, let me take the picture and let me address the common question here. So the first thing I ask myself every time I look for a trade, do I have strong triggers? And we all decided yes, right? Absolutely we do. Smalls above the large, larger wide, separation. Without question, this market is showing me strong triggers. And then I ask myself, it's just a flow chart, guys. That's all it is. If then, if I have strong triggers, then I ask myself, do I have a clear path? And if I don't know the recipe, small and large above the fib, then I might call this a 50-50. And Wayne, I think you may have called it a 50-50 because of the mid-band, correct? Or was that referencing your picture? Your picture maybe was a 50-50. Guys, the mid-band is only a termination condition if the large triggers are a full bar away. That's it. That's the only time the mid-band is a termination condition. Wayne says that it scares him, right? So Wayne, from a bad bottom, I might agree with you. When I get to that mid-band, let's look for the reaction. There was none. It smoked that mid-band 100%. The small triggers smashed through. This is where I don't worry about it, but that's okay. Technically, we do have a clear path. If you're not a fan of the mid-band, you don't have to take this trade. And I want you to see the entry rules written out. Rule number 3 says that I will buy a pullback at an area inside of triggers. There's my triggers. There's my only areas. Do you guys see how not only am I outside of the triggers, but I am also I'm way on the wrong side. There's no telling if this area is going to hold or not. Does that make sense? Rule number 3 is not met. If you talk to yourself in terms of advantages every time you look at the market, you're walking yourself through this flow. Do I have momentum? And we answered yes, right? So that was absolutely we had momentum. Did we have a clear path? Absolutely we had a clear path. Did we have an entry area? Dagnabbit, there goes one of my advantages. I don't have an area inside of favorable large triggers. Does that mean that there's not potentially a trade as you grow with software? Well, it means that if I want to be comfortable entering this trade, if my rules say that my initial stop goes 4 to 5 ticks below the triggers, I'm already on the wrong side of my stop placement as well. I hope these areas hold, but I've already just blown through everything. So what can I do? Guys, remember when we said when the market gives you a reversal bar, you have some place to put your stop 2 ticks below it? So I've already given up my entry area. 33% of my advantages are no longer in play. But I've got 66% of my advantages. I have momentum and a clear path. How can I give myself a fighting chance without all of my advantages? Well, I wait for the reversal bar. Because this reversal bar says to me, hey Mark, we're going up with momentum. We're going up with the clear path. And something's wrong with my chart because that should have been right inside. Let me reload my 5-1 template. Something was wrong with my chart. But that's one of the things you can do, guys, is you can say, it's not perfect, let me force confirmation. Let me force a reversal bar. And let's go back to 1032 and see what it looks like when this loads. Does that make sense, guys? Right now I'm just trying to turn stuff into lessons. That's all I'm doing, is I'm trying to turn stuff into lessons. Odds favorable, clear path at 844. Not at all odds favorable. Very much weak triggers, right? Very much weak triggers, but definitely clear path. Not an area inside a favorable large trigger. So we're giving up 66% of the good stuff. And you had to manage out of it, didn't you? And you got out break even. So check this out. Let's do the same thing with this chart. Did I have momentum? I did not. That's 33% of what's good. Did I have a clear path? I did. Did I have an entry inside of favorable large triggers? I did not. There's going to be a point in your life where you say, with 66% of my advantages gone, I don't want to work that hard. Or you can be such a great chart reader that you take it anyway and you manage out. But with 66% gone, it's not much of a surprise that it didn't finish, that it didn't go. Does that make sense, Wayne? Guys, I read your annotations. And if you tell me that's odds favorable, I'm obligated to correct it. Nice trade though, Wayne. Odds favorable? Absolutely. Clear path? Absolutely. But you're not trading there. You're trading here at 84, which is directly into a termination condition, and you get stopped out. And then you try it again into a termination condition, and you get stopped out. So once again, Wayne, if you tell me that's a clear path, this is where your trade took place, right there. I am, 844, 838, 838. I don't know. I can't see your entries over here. So the price is 84.5. 84.5. Hold on. 84.5 is right here. So there's 84.5, Wayne. Your entry was 83.9, which means you got in somewhere right here. So I'll look at the prices because the timestamps don't always line up. But you're in at 83.9. And I know because that's 83.8. And if I look at your chart, 83.9 is somewhere right here, right into the term. Am I mistaken? I don't think I am. Because 84.5 is your one-to-one. Timestamps do not line up. They are two separate charts. And inside of one bar on this chart, what market is this? That's okay. I don't care if you guys tell me I'm mistaken. Doesn't bother me, not even a little bit. But I'm also stubborn as shit, so I'm going to open up a gold chart. And we'll take a look. Because guys, I'm wrong sometimes. Turns out I'm human. Well, mine looks different than yours. So help me out with this, Wayne. Can we agree that you entered at 83.9 and right about 838? So I want you to look at your large chart. This one is at the 838 timestamp, right? Your 838 timestamp is right here. I don't understand what you did in there. Are you Central Time? There it is. Nope, that's not it. That's it right there, right? Take care, Jay. I just want to make sure that I'm giving you the best feedback I can possibly give you. All right, this was your entry at 83.9. And again, I reserve my right to be mistaken. You went long here directly into a termination condition with everything saying down. Is that fair? Because there's your picture, right? So this is even worse. Oops, hold on. Let me get the timestamps in there. Divergence off the low, just through the mid band. 83.9, there's a little double hit, boom, boom, same thing, goes down, spikes, spikes, down it goes. Do you see how your synthetic triggers are down here? Your synthetic triggers are down here. Your synthetic triggers don't roll until the 48 timestamp, which is over here. So here we have momentum and path. And if you took that one, rock star, totally different look. So I'm going to stick to my original assessment that you traded into those one-to-ones, and you did it without momentum. Okay. Are we having a battle of the wills? Look at this. This says 42 right here, right? Am I reading that wrong? This says 42 right there. Wouldn't you agree? And that arrow is pointing to the right side of it. And this says 38. 42 is not even on your small chart, Wayne. I'm telling you, you can always tell me that I'm mistaken, but I'm not here. We can finish this conversation privately if we need to. But it doesn't. Look, 42. 42 is not even on your small chart. It hasn't happened yet on your small chart. Unless you've got a portal or doing some Doctor Strange stuff, that is not the same bar. Not the same bar. Now here, the top of this bar, and no, that's not the same time. So let me show you something. Guys, you can't use timestamps. It doesn't work. It never has. Inside of this one bar sitting on the 47 timestamp, it goes from 44 all the way to 47. Inside of that one bar. You can't line up timestamps, but if you circle a price on that bar, it is without a doubt the price. Actually twice on the small chart. Once on the way down, once on the way up. Timestamps don't work. They're two different time frames. It could take 30 minutes. It could take 30 minutes to create a bar on the large chart. Check this out. Let's go middle of the night where it moves really slow. Man, gold has been cranking, haven't they? And I know this because I was working with a friend that kept showing me timestamps, Wayne. And I'm okay with that. But that one bar in the middle of the night there, let's see if we can find it on the small chart. These are just conversations that I've had 1,000 times. On the small chart, that one bar from the large chart goes from 2013 to 2018. So that 1 minute's 5 minutes. Okay, I'm done beating that horse. But if you circle price, any price that I circle on this chart shows up on that chart in the exact same location. That's why we study tails by circling the tails, because it's guaranteed to line up on the small chart at the areas inside of favorable large triggers. Good stuff. Great lesson. I'm going to walk away for a minute and take 5 minutes. Guys, do the same if you feel like you need to. I'm going to get rid of gold. There's a strong trending crude market. I'll see you guys in about 5 minutes. Go stretch your legs. Post them if you got them, guys. All right, guys. I am now, Gary. Let's get into our last hour. Wayne, one more. Hey, look, it's not on that one, Wayne. There's your first trade, 50-50, nice job. There's your second trade, where you went long directly into the termination condition. Are we good? Are we still BFFs? Timestamps, man. Timestamps work, but not as well as circling prices. I promise. It's okay. I've just been doing this a while. And nobody ever does it intentionally, guys. And I encourage you all the time. That's your stop. Oh, you went short? Okay. So you went short from resistance. Why'd you get out? I saw that one. I thought you went long. So it wasn't even a matter of where it was on the chart. It was a matter of whether you went long or short. You held that one up to there. I thought that was a long. That's where I needed to be corrected. I had it in the right area. I had the wrong direction. I didn't realize that was a stop. I didn't realize that you held that one for so long. And you got back in and got stopped out 2 ticks below. Nice trading, Wayne. You have a plan. Well, the first trade had momentum and the potential to break. The second one had the beginning of momentum. Well, tail end of momentum and a clear path. Yeah, just no entry area. Same one twice. But that one never got above the reversal bar and continued down pretty well. 84.5, 83.7. You were willing to give it 8 ticks, 7 ticks. I like it, predetermined. And again, Wayne, you know your plan better than I know your plan, right? And guys, I make mistakes, and I said that. I make mistakes. I was talking location, you're talking entries. I messed up direction. I'm human. I'm fallible. I don't need to be right. I don't mind being wrong. I was wrong, Wayne. You win. I'm saying, do you have an automatic 7 or 8 tick stop? Or do you go behind the reversal bar? One keeps you in the trade. One stops you out of a big winner, it looks like. I don't know your plan on management. I don't know your stop placement when you take these. I don't know if you go above the bar, if you've got a predetermined number, if you wait for the bar to get the bar. It's difficult for me to comment on your management. It was 7 above the mid-band. Right on. Once that mid-band's outside, that's why I say on entries, you don't know. You don't know if it's going to go 10, 12, if it's going to go 10,000. Once you're on the wrong side of those triggers, things begin to change. Management has to be a little more thought out than just a number. I like it. So you got in on the way down, right? And it gave you the reversal bar that said, here's your confirmation that we're going with the momentum in the path. What a great place to put a stop, because the buyers have already failed and headed back down. I love your entry, dude. I think your entries are rock star, and they show a great level of patience because you're not arbitrarily jumping in outside of the triggers, and I think that's brilliant on the plan. I love it, that half bar entry. But I think that the top of that bar, that defines, in my opinion, that defines, and let me talk about And I'll just use your chart because your chart's such a great example of these entries. So when the large chart says down, you know, the sellers are in control. This is that fight by the buyers, right? And once you're on the wrong side of the triggers, you're really hoping that the buyers get stuck at the mid-band. But because we're on the outside of the triggers, I don't know. I don't know where it's going to go. I don't have that clear definition for an entry. This reversal bar says, all right, now we're going down with momentum. Now we're going down with path. And since you couldn't define entry, you know, super specific because we're on the wrong side of the triggers, now I've given you something to put your stop behind. Now we've gotten confirmation of the move down. This is exactly, the top of that bar is exactly where the buyers failed when they tried to counter. So the stop makes sense 2 ticks above that. Does that make sense, Wayne? It's kind of using that confirmation, and you just get in before the confirmation's complete. So when I teach entries every morning, one of the things that I think that it does for us is we define where the area is most likely to bounce through the trigger lines and the areas within. But once you're on the wrong side of those triggers, you don't know where it's going to stop. So once the market goes in the direction of the trade, my stop goes 2 ticks below that bar. So if you're counting on it from the half bar point where you enter, you still need to be below that failure point where they started back up to at least have an idea. Does that make sense? That would have made it into a winning trade. That's why we talk about the confirmation bars. What is it doing? It's confirming that the market is now headed in the direction of your momentum, that the market is now headed in the direction of your path, and that the buyers failed and the sellers were able to create that down bar. So when I teach the trend trade, it's that confirmation bar that's our first stop movement. The first stop placement is 5 ticks beyond the triggers, but since you're entering beyond the triggers, it doesn't even make sense. Your entry is 5 ticks beyond the triggers. That's where you go to that second one, that confirmation bar, just giving you something to put your stop behind. I love this lesson. This is such a good lesson. And let me see if I can find... talking about split triggers. And this is kind of the same thing. When the entry is a little harder to define, let me make this smaller, sorry. When the entry is a little harder to find, whether it's split triggers, wrong side of the triggers, that confirmation bar puts that 2 ticks behind it. I think that might pay some dividends for you, Wayne. Go back and look and see how many times you get stopped out on these, and it's not a lot. You're so in sync with what you're doing. Maybe that'll be helpful. I try to be helpful. And then Paul, strong triggers, clear path, no areas inside. I would say the same thing. Waiting for a little confirmation right at the area instead of hoping the area holds. Sometimes that helps, sometimes it doesn't. And you said if it makes a down bar on the large chart, that's where you'll put your stop. Okay, so predetermined, I like that. Wayne, you may be able to use this one too. Paul uses the reversal bar marker on the large chart. So if the large chart makes a reversal bar beyond where he's hoping it holds, now he's got that established risk. I'm not sure that would have helped you here. That would have pulled you out on this one as well, I think. So I don't know if it's a perfect plan, but that's Paul's plan. I dig it. He can define his risk, and I think that's what's important. When the entry rules aren't spot on, being able to define your risk. What's acceptable risk? Wayne, I learn something every day. I love that you learned something today. I learn something every day. I'd love to say I know everything. I don't. In the grand scope of things, I know squat. Steve Diego. I love this setup. So let's check it out. Odds favorable momentum. Price cleared trouble. Where's your entry? I don't think it did. Oh, that was a fib update. Yeah, amen, Wayne. I agree 100%. So, did the fib update show up? It looks like it did. Steve Diego. So Steve had odds favorable at a clear path, and then that, I guess the 10 a.m. maybe, fib update. Because it just started printing. And he gets out, quick hit, nice job. $200 in 2 seconds, I love it. And then here, waiting for the back of the bar to clear, it almost does. Quick hit, didn't work out. Loss of momentum, had to exit manually because no reversal bar marker, so 4-tick loss instead of 1-tick loss on contracts, $85. I'm looking for prices here. 46, 46. Yeah, it looks like... Steve, I might be mistaken. It doesn't look like the... maybe it did. That's close. I like it. It just didn't work. Great job. It's so tight. No odds favorable momentum. With everything up, you're trying to go up with it, and it worked out. Nice job, Steve Diego. And yep, Gary. So I had to turn mine up to 100 yesterday because someone couldn't hear me. I'm sure I could turn that back down, but there we go. Maybe that's easier on your ears. Turning it down. Good stuff. Great trading today, guys. Exactly, Rob. I'm telling you guys, there's always something to learn. And the great thing about this room is, guys, I made a mistake on Wayne's chart. I thought he went the other direction. So I'm like, you traded into a termination. And he's like, no, I didn't. And he traded from it. I will be wrong every now and then. I want you guys to give me a little grace. Here's that gap theory almost. Look at that perfect termination condition. Look how far away the large triggers are. It's likely to close the gap to those large triggers. Man, the S&P, odds favorable, clear path tail, odds favorable, clear path tail. What do those look like? Right to the mid-band before the triggers, right at the mid-band in the triggers. And then once you get outside of the triggers, it gets a little silly. The outer band trade, Wayne? Yep. Look at that. 3 divergences in the same price range, and that was the push back to the mid-band. Wayne, this is where the mid-band should be scary. When you reach that mid-band and the large triggers are a full bar away. This is the gap theory. That's when, if you went long, that's a great target. But this will make me pump the brakes. Strong triggers, just full gap back to the large. Remember, the recipe for strong triggers is always the same. Small above the large, large open, space between. But then we hit the mid band and the large triggers are a full bar away. That is textbook when your mid band is in fact a termination condition. Well, at the very bottom, there's not strong triggers. I'm not, Steve. But we had 3 divergences in the same price range. And that's where the push up came from. And then once we hit the mid band and these are below the triggers, we have to say, all right, don't get in at the 1-to-1s. That's a termination. Don't get into the mid-band. That's a termination. It's more likely to close the gap than it is to not. And since it's a bad bottom, do you guys remember the lesson? They might be going for that fib there. Since you know who Karnak is, yeah, you're old too, huh? We are showing our age, ladies and gentlemen. All right, Miss Jen, let's see what you did. Jen says, check it out. Odds favorable, back of the price clears trouble, so I'll get in. And it just didn't go as far as I needed it to, and I had to get out. And there's a good example of why I don't trust the timestamps. Nice to see you. Where that circle is, it didn't clear yet, but the next bar is. And you got in 33.75, and it went all the way down to 28.75. No, right about 29.25. And just lost that. Didn't have that momentum on the momentum trade. Just didn't go. They wanted to dance. You are a vicious dog. Yeah. And great exit, right? No reason to sit and hope. You took a tick on the first one. Oh, accidentally bought one. I've done that. Whoops. And then on the reversal bar, you got out, took it, lost the momentum. Great job. I've done that. I just did that in class, didn't I? I went to change the chart and hit buy earlier. Oops. Happens. Man, remember we said that your synthetics and large both define where the retracement is most likely to occur? They're still pulling back, guys. That gap theory's still going. We'll see if they wanted the fib. We'll put a circle down here. Can't have momentum with flat triggers. Can't have a clear path into that. It's not a downtrend. It's an uptrend. Is it okay to do nothing if I can't find my rules being met? Is it all right to not take a trade? Like, will there be times when I have to just sit on my hands? Get a friend, sit on their hands, whatever works for you. Look at that crazy market. There's a term, there's a term, there's a term, there's a term, there's a term. Guys, this is what it looks like when a market fights. Oh my gosh, it keeps going back too. There's no reason, right? There's no reason. Go walk the dogs. Oh, I just said that. My ears just pricked up. You know where the lines are. Nearly dark there. It's London. It's always dark there and dreary. We need to get you to a beach, Jen. I think London is probably a lot like the Pacific Northwest in the United States. It has so many redeeming qualities. I can't live without the sun for that long. It just doesn't work for me. Look at that. There was the gap theory as well. So gap theory on crude, potential gap theory on the S&P. Guys, 90% of your day. This is 90% of your day. She lives in Washington State. Well, it depends on where in Washington State, Jen. I was in the southeast corner. And it's beautiful. It's the high desert, and it's like 320 days of sunshine a year. Seattle? She's probably in Seattle. Yeah, your sister's a glutton for punishment. That's where all the hipsters go. I hate myself in sunshine. I'm going to Seattle. Yep. All right, Kurt. Why is that not a great bottom? Dallas got hit, Rob. We just got a little rain. I'm a few hours south of Dallas. So what's your recipe for a strong top or bottom, Kurt? Do you have it? Do you have it committed to memory? Hold on. I know a guy that did a lesson earlier today. Let me see if I can find it. Check it out. No divergence, no, just divergence, no fibs. Who cares? So there's a couple things that I want to talk about then, Kurt. And thank you, because now you give me something to talk about. And then we'll talk about your trade. So a termination condition. You guys notice that it says support, resistance, 1-to-1s, divergence low, divergence high. Any of those can be a termination condition, right? It doesn't have to be fibs. Guys, I love fibs. I'm a fibaholic. But it doesn't have to be fibs. Kurt, it can be any one of these things that qualify for a termination condition. And then my recipe is, if I have it, and the triggers don't break through and it reverses the market, it's a strong bottom. So if we back up on yours, price reached the divergence low to the tick and reverse the market, that's awesome. So that actually is, it's a strong bottom, but you're right, you're so far away with it, so far away from it, it already did what we would hope it would do. And then we get into that one where you don't have odds favorable, but you do have a clear path, and you did have an area inside of triggers. So you entered on the confirmation bar because the momentum wasn't perfect. And this goes back to what we were saying. If you talk in terms of advantages, you told yourself, I don't have this one. It's not perfect, right? I have this, and that's there, but at only 66%, I love a little confirmation. I love for the market to move in the direction of my trade. I love for the market to go up with the trend, to go up with the path, to go up with that weak momentum, because it gives me a place to put my stop. I don't get into this trade hoping. I get in with a little confirmation, and just beautiful. And you took it wonderful. And Kurt, that's your thing, man. You are the confirmation king. You do great with it. But it's because you're talking in terms of advantages. You found your niche. But can we explore the seedy underbelly of you guys that love confirmation? Kurt, what if I have momentum, clear path, and an entry? What if it's perfect? Do I have to wait for confirmation? Do you wait for confirmation even when it's perfect? That's the answer I was hoping for. I've had people that get so into the confirmation bar that, one, they trade every reversal bar they see. Well, that was a confirmation bar down. Well, no, it's not. It's just a down bar, right? That one confirms. And when it's perfect, you don't need it. But when it's not perfect, I love it because you manage your risk. Really well done. I dig it. I dig it. But a lot of times people will wait for confirmation when you don't need that confirmation, when it's already perfect. I like confirmation when it's not perfect. That's kind of the language that I use. You like confirmation on the 50-50? So once you get that confirmation, Wayne, where do you put your stop? Below the reversal bar, right? That gets you in? That's the expanding on the thing you learned earlier. That's the nice thing about confirmation. But remember that confirmation isn't done until that bar prints. Until that bar prints, it's not confirmation. And that's where you see fluctuations. And this is more, I think, NASDAQ traders. You'll see it a lot on the NASDAQ where you're waiting for confirmation And you'll get these fluctuations like that where you think it's going to be and you anticipate it, and then it continues down. And obviously we're in determination conditions. Let's see if that one does it. Where you think it's going to be a confirmation bar, but until it actually is, and I'm the worst about anticipating these. And there you go. NASDAQ's fast. I'm the worst at trying to anticipate confirmation bars. And for me, they're almost never if I enter the market before it's true. But that's also me. I've got an affliction. My rules say in my NASDAQ trading, I have to get in on a reversal bar. And because the market moves so fast, it can tick your reversal bar and put you in and not actually give a reversal bar. So when I use them, I use it +1. The day is way too spiky. You think so? Too fast to make good decisions? Weak triggers at a fib. Look at that bounce. It can. It can also plow right through you. So you think of it in terms of, I don't want to miss it. I think of it in terms of, I don't want to get absolutely slaughtered on its way down. One thing I realized over the Christmas break is that I can't keep up with the NASDAQ from 9:30 a.m. until about 11. It's just too fast for me. I can't make good decisions. I can't get my stops in place. And that's just me. I don't have the reflexes that everyone else has. So I just don't. And man, it's hard. When you finally get to trade during the day, you're not teaching class, and then you realize that you have to go do something else because it's too damn fast. Look at that termination condition. How's that for holding? I like it pre-market, Wayne. I think that it's really smooth before it opens, and I love it after class. I love going to the NASDAQ after noon Eastern because it just mellows out. It's like half the volume goes away because they get full bellies at lunch. Look at that termination condition. Pow! Straight to a termination condition. Think they don't know where these numbers are? There's no doubt in my mind they know where these areas are. You can choose to trade into them or not trade into them. That's up to you. That's up to you. Now it has the potential to break. Divergence on a 50-50. Not always my best look. Some of you dig it, some of you don't. Indecision. Look at that. Weak top in the mid band. Held. Patterns repeat themselves, ladies and gentlemen, all the time. Look at that. There was your weak bottom. Closed the gap to the triggers. Retested it. Are they gonna give us an entry before they hit that blue line? What do you guys think? If I get a reversal bar, isn't that mid band my lowest point of resistance inside of triggers? But I'd have to get it before it hits that divergence low. Otherwise, it's a termination condition. Oh, dag nabbit. Wayne, do you trade it like literally at night, sun's down, 8 p.m.? I've never looked at it at night. Even when I market replay, I stop at 3 p.m. If you got caught taking this long trade, On the 50-50 look, you broke the rule about a strong bottom. Now it's a 50-50. No divergence, only the potential to break. We'll just watch it, see what it does. Guys, I'm out of pictures. What do you want to talk about? How we doing? Steve, how you doing this week? Starting to learn the lingo a little bit? Starting to recognize some of the things? I hope. $50-50, not from a strong top. Goes against the KISS plan. Once London closes, it slows down the NASDAQ. There's London causing trouble again, Jen. Anything you guys want to talk about? Anything you're having challenges with? Anything you're working through? I'm here, guys. The only way I can help you is if you raise your hand. Not a strong top. 50-50. There it is. There's that first rule on the KISS plan. 2 times. You guys see it? Right there. Why do I hand you guys the KISS plan? Because it optimizes your chances of success. Because it gives you a fighting chance, guys. That's my goal, is to give you a fighting chance. To be able to recognize advantages and turn them into trades. How about now? Now we have momentum and a clear path.
Order submitted.
And we have areas inside of triggers. That's not a 50-50 anymore, is it? Does that make sense? That was weak triggers. That was a 50-50. That was a 50-50. But my mid-band's not a termination because my large triggers aren't a full bar away. Technically, guys,
Order filled.
if I enter 2 ticks above, my stop goes below the triggers where the market shouldn't. My first target's at 100. My second target's at 200. If I get a reversal bar,
Target filled.
whoop, there we go. First target reached. So I go break even.
Target filled.
Oh, man. There you go, ladies and gentlemen. The high probability trend trade. What do you guys think? That was it, right? That was momentum, path, and entry, 100%? Did I do anything wrong? No, Kurt, you were right. That was nice. Was there any reason not to enter this trade? And look at that. 2 ticks above the mid-band was the low tick. Did anybody else catch it? Guys, I'm up almost $800 on Simulator. I've only taken 2 trades today with you guys. Now I've got a 50-50 on the 1-to-1s, but I'm not from a strong bottom. You had a fib there, Pa? Oh, you sure did. It would make sense not to take that trade. I don't have that one. I reloaded all my historical data today, so we might be in a different spot on stuff. You don't delete your folders enough? Okay, yeah, I do mine every day. Literally every day I go through and rebuild, so that would make sense. But I think it's pretty cool. And if you're brand new with me, guys, I just took what we teach every day. And look at that. Because of my entry, I hit my first target before I ever hit my reversal bar. I was paid and break even before I even got a confirmation bar. I love this stuff. I love this stuff. And if that didn't make sense, if you don't understand why I did that, I need you to raise your hands and let me help you. Karnak is back. It's just a pattern, right, Steve? It's just a pattern. That's all it is. I promise you, I am not smarter than anyone in this room. But I can recognize patterns, and I'm learning how to follow rules. We're all learning how to follow rules. We still break rules every now and then. I do. I did Friday. I broke my rules 4 times in a row. I formed opinions. It cost me $1,200. I ended my Friday negative. It happens. I'm not afraid to admit it. I will never, ever tell you guys that I trade perfect 100% of the time. I don't. I haven't met anyone that does. You find a way to bypass the human element, let me know. But if you're working on that rule adherence, this is pretty cool. This was made by a guy that's been with us almost 20 years. And when he was learning these rules back in the beginning, one of the things that everyone comes to the realization of is that the rules protect you, that the rules help you make money, that the rules keep you from giving it away when you shouldn't be. And he made this, the penalty box rules, and I love this. So if he didn't take the right entry, maybe he gets in late or whatever, it's a minute. And he literally stood up from his desk and walked away for a minute. And if he enters late, it was 2, and exiting for no reason 3, and moving stops to lock in profit. Who hasn't done that? 5 minutes. Giving up most of the profit by exiting late, 7 minutes. Guys, they get longer and longer the more detrimental they are. And he lived by this every day. And eventually, guys, you get tired of standing up and walking away from your computer. You'd rather trade. So you stop doing these things that cost you money, and you focus on the things that are producing. 50-50, and it's already got 2 divergences. And if you thought a confirmation bar would be enough to save you breaking your rules, well, you got stopped out. And then if you said, well, this one's the one that's got to work, well, then you probably got stopped out. Anyone take the 50-50 with 2 divergences, thinking they were going to buck the system? I'll forego one every now and then if I have that strong bottom in place, but notice how the triggers don't agree. Isn't that odds favorable momentum to the downside? It looks like it on the small chart. Love strong bottoms. Me too. Weak triggers, retracement. Guys, look at the NASDAQ. That's 8 minutes. Boom. NASDAQ is fast. There's a termination. Crude is defining the areas we have to break before we have a clear path. They're showing it very clearly. Hopefully tomorrow we get a little more out of you guys. I'll be rooting for it.